Welcome to the weekly video update, where I'll go over the action in the market for the week of October 23rd through the 27th, and then we'll see how things look for the week of October 30th through November 3rd. If you're long in the market, you're probably pretty happy that October's coming to an end. Historically, October can be kind of negative. We just finished up the worst week of the entire year historically, and we're possibly coming into some positive seasonality. Now, we don't really know if that's going to happen. It's just historically, the end of October going now from until the end of the year tends to be positive for the market. But we have almost zero confirmation of that on our charts. They haven't turned, at least, and gone up yet. So it could be quite dangerous to try to front run this. But we do have that going behind us. And I'll show you some charts that I have to go through that. Before I get started, please know that in every video I post, whether it's a daily video, weekly video, intermarket analysis video, the deep dive video, I always put a PDF of the slides that you see right now in the description, whether it's on YouTube or Rumble. If you want to download those and look at them, sometimes it might be a little bit difficult to see the charts, and looking at the PDF might help you. Also, there's a thing called pivot points that I post every day, and these are really quite accurate. I post two different charts. There's a chart that lasts for the whole month, and then there are charts that only apply to the next day. And this is on the community tab in YouTube. I really can't do that in Rumble. I only have the availability to do that in YouTube or on YouTube. I do have a private Facebook group that you're welcome to join. It's not really all that active. Maybe you can join and change that around a little bit. I will be posting a new poll. I'll go through the results of the latest poll just in a few minutes here. And I really try to keep a close watch on YouTube comments. I want legitimate comments, even if you disagree or you're like, you did a terrible job explaining that. Or if you want to say something positive, of course, that's always nice anyway. What I'm trying to do is get rid of the crap comments and the bot comments. And I want that stuff off of there. I really guard those comments pretty heavily. The minute I see them, I actually get rid of them. And somebody posted a comment this past week on a couple of different videos, but I couldn't read it. I couldn't even see it to know what it was saying. So if that was you and you were trying to post something legitimate, please let me know about that. And I try to respond to all of the legitimate comments that are made. Sometimes if people make just a statement that I can't really agree or disagree with, I'll just leave that alone. But if you have something about what I'm doing and maybe some clarification of how I'm doing it, please feel free to do that. I also have an email address that I give at the very end of this video. It's also in the description. You're more than welcome, I should say, to go ahead and send me an email if you want to keep it a little bit more private. I also post the videos on Rumble. So if you can't find me on YouTube for whatever reason, not so long ago, my whole channel was taken down and I didn't know how long it was going to last. It ended up just being a few hours, but who knows? Something could get flagged by one of their bots, takes me down. I have to wait until YouTube can go in and look at it and see, oh, everything's okay. But I also post on Rumble. So if you can't find me on YouTube for whatever reason, you may be able to find me on Rumble. And the reverse of that is also true. I haven't had any problems really with Rumble, other than sometimes it takes me forever to upload the video. But if you can't find me, go over and look on YouTube. Also, before I get into the video, if you watch the daily video update that applies to Monday's session, right before I started recording, there was some loud construction type noise going on, and then it stopped. So I decided to try to record, but I was really rushing and I made some mistakes. There was one time I said things are looking positive when actually they're looking negative. One time, instead of saying mega caps, I said micro caps. I've got so many things swimming around in my head when I record these that I get tripped up. Sometimes we're looking at a blue line and I'll call it red for whatever reason. So I ask your forgiveness in advance for that. I also ask your forgiveness going forward because I'm going to make mistakes. I always do. And even any mistakes that I might make in this video. All right, let's go back and talk about what happened. We were down 2.53% on a historically weak week. There, how's that for double words? We were above average with the volume. That has stayed pretty constant. And our technicals are more negative than positive. I'll go through all of these. I'll also try to compare them to the daily charts. I also have a number of extra charts in the daily section of this video for those of you that don't watch the daily video update, because we're breaking some pretty significant support right now, and I just want you to be aware of that. It's about inflation, interest rates, growth concerns, and the big geopolitical event right now is Israel. And there's also been some bombing recently that the U.S. has done on Iranian-backed targets in Syria, and that can really spook the markets. You have a lot of people that are afraid to carry things over the weekend. They might be hedging their positions, or they may just decide to go ahead and get out. We are going to have the Fed meeting this upcoming week, and it's not so much what they're going to do that's concerning the markets. It's what are they going to say with their statement, and then Jerome Powell's press conference that he gives after that. Our trend right now, it's still the same as it was a week ago. We are in a weakening trend. We do have a negative bias because the red line's on top, and I'll show you that chart. And we're also looking negative on the daily charts. So for the week, the Dow was down 2.1%, the NASDAQ down 2.6%, the S&P is down 2.5%, and small caps were down 2.6%. So this was a broad-based decline that was well outside of just the mega caps having some difficulties. In fact, they held up pretty well in Friday's session. So for the week, here are some bullet points. The S&P did end up dropping below its 200-day moving average. That was earlier in the week, and kind of bounced around it a few times, but now we're more below it. So when we hit the low on Friday, that registered a 10.3% loss from the July 31st high that we set. So now we are, from a technical standpoint, in a defined correction. That means when we're falling more than 10%. And we're also dealing with the 4,100 level. A week ago, we were dealing with the 4,300 level. Now we're dealing with 4,100. The decline, as I said earlier, was pretty broad-based. It wasn't just refined to a few stocks. It was pretty much across the board. Earnings reports came out, and we are dealing with earnings season now. We had Google. They came out with a pretty good report. Yeah, and they were down 9.8%. Meta, which is Facebook, they were down 3.9%. Microsoft and Amazon, they came out with reports that were actually treated as positive, and their stock went up. And then we had a number of different household name type companies that came out, like Verizon, Coke, the Dow, RTX, GE, 3M. They had more positive earnings reports that came out. Then the geopolitical events. This is where I just talked about, where the U.S. did carry out airstrikes against Iranian targets, or Iranian-backed targets. And this took place in Syria. We don't know if that's going to escalate things. And then there's also the latest news coming out of Israel that they're going to be expanding their ground operations in Gaza. There was some traction made, I guess that's a pun somehow, in the UAW strike that's going on, where Ford has reached a tentative agreement. And the European Central Bank, for the first time in 10 times, they had been raising their rates. Well, this past week, they left them unchanged. And then real GDP, that's a big one. It came in a lot stronger than expected. This shows a pretty healthy economy. That's tending to spook the markets right now because good news is seen as bad news. And it came in at 4.9%. They expected it well under that, around 4.1 or 4.2%. And then the big inflation report that we received on Friday about personal income and spending, yeah, it was friendly to the market and came in as expected. But it's not showing this disinflation, which is what the market wants to see right now. And then interest rates were down. The dollar ended up being up. So interest rates going down actually gave some support to the market, where the dollar is producing some headwinds. All right, and then I have to click through this. We're keeping an eye on the VIX, and I go through this in the daily videos as well, where possibly we've topped out at some point in October. If this is going down, that means stocks are going up. Maybe we're into this period now as the VIX continues to go up. Then we're also keeping an eye on inflation, where we're comparing 1966 through 82 to what's been happening lately in the market. And they've been kind of tracking each other, where we do see inflation start to taper off. But then be warned, after that, this is the late 70s that we're showing here. And if you grew up during that time, you know that inflation kept going up and up and up, and we didn't have any growth in the economy at that time. We also settled at 4.85% with the 10-year yield. We're above the 4.02% level that this research put out by Renmac suggests that anytime we're above that level, this is when it starts biting into corporate earnings. Here's the poll results. So first of all, the S&P seems to be roughly following seasonal patterns for a pre-election year. Sometimes we're pretty close to that. Sometimes we kind of deviate away from that. This would suggest that prices will fall until there is an historical bounce. I tried to be all educated there. Near the end of October, do you feel that this pattern will be followed or that prices will deviate from historical norms? Prices will follow historical, what has already happened in the past, 78%, where 22% think that we will deviate from that. And that we're still waiting for that to play out. Then do you feel that the geopolitical events in Israel will either get worse or better? Escalate, 89%, 11% said de-escalate. This was a question that I posted, and I should have done a better job of wording this. Usually when I ask these questions, they're meant for the upcoming week. What do you see just happening in the very near term future? And I didn't really specify that here. We were getting close to that 5% level with the 10-year yield. And so I said a week ago, it briefly came up to that 5% level. Do you feel that we'll break above 5%? And I meant in the upcoming week, or that we'll stay back down under 5%. 83% said that we will keep going above 5%, where 17% said that we will go lower. We're actually still under that now. The chart that I showed before that, we're at 4.82% right now. And then the S&P closed slightly above its 200-day simple moving average. Well, we've ended up breaking below that. So do you feel that we will break below it? And remember, these questions are a week old. 67% said that the decline will continue, and support, we tried to bounce up off of it a couple of times, but that just wasn't happening. So 33% thought that we would find support there. Now we're kind of keeping an eye on the NASDAQ 100 200-day moving average. That's kind of the last line in the sand of support, and I'll show you some of those charts as we go forward here. Looking at earnings, this is justifying that stock prices could end up going higher. And I've been showing this week after week, whether you're Morgan Stanley or the consensus, we still see revenues into the future being increased. Now, these are forecasts and these can change, but this is the trend that we've been seeing. FactSet had a couple of different posts. We're in the middle of earnings season, and I'm not going to read through all of this because it's kind of convoluted. I'll just go through the main parts. I'll try to follow the laser pointer here. As of Friday, 49% of S&P 500 companies have reported their actual earnings. And then 78% of those are above estimates, which is above the 5-year average and above the 10-year average. When you take it all together in aggregate, companies are reporting earnings that are 7.7% above estimates. And then you've got the 5-year average and the 10-year average to go into this. Historical averages reflect actual results from all S&P 500 companies. There's actually, I think, 504, 505 companies, not actual results from the percentage of companies that have reported through this time. Then earlier in the week, they had another post. This is just, and now this can be a little confusing because if you look at this chart, this is quarter over quarter. And then you look at the headline and it says they're reporting the year over year as being lower for the 7th straight quarter. So you kind of have to take all these last 4 and put them together because it looks to me like it's still holding up. But again, the chart is quarter to quarter, but the headline is year over year. So you get some different results that way. Getting into our charts, going back to Monday, we were doing okay in Monday's session. We were able to get back above the 200-day simple moving average, but not for very long. We ended up closing down below it. Then on Tuesday, we had like this big M day here where we started off pretty good, came down. The daily pivot held as support, and then we ended up higher. That was a more positive day. Then things started to get a little bit worse after that. On Wednesday, we opened lower and declined lower. On Thursday, we gapped lower and actually ended up closing lower. And then on Friday, this is when we started to come down and test the 4,100 range. We closed a little bit up off of that, but this is not a healthy looking chart. So for the week, we had the Dow was down the least at 1.58%. Please keep in mind, this is just the 5 trading days that we just finished with. And the NASDAQ and NASDAQ 100 were down the most on the week. Going back to the beginning of the year, we have the NASDAQ 100 and the NASDAQ that continue to be in the lead, followed by the S&P, where now all of the other major indexes, the Dow, NYSE, and the mid-caps, they are now underwater going back to the beginning of the year. And for some reason, the small caps aren't on here. Going back to the all-time high, we have the NASDAQ and the mid-caps now. Somehow the mid-cap chart didn't get on here. So they're doing pretty bad right now, and I have a chart to show you that. Different sectors, we had a down week. So we had energy that got hit the most, followed by communication. This has been a stronger area in 2023. And then we have some of the value areas. We had one sector that was up, and that was utilities, and they got hammered on Friday. It would have been up a lot more than this. Looking at our relative rotation graph, we're seeing that energy, which is leading the way right now, but it's starting to come down after it's seen some weakness. We have communication trying to come back a little bit. Some of the positive earnings reports are helping that. But then we have the, which one? I have to look over on. You think this little chart over here is for you? It's actually for me. We have discretionary, which is showing some weakness. And then we have tech, which is also continuing to show weakness. We have some other areas that are getting a little bit stronger, like the financials. But we had a death cross in the financial sector. Looking at our daily chart, utilities are showing a little bit of a bounce. Real estate still is continuing to be rather weak. So when we look at the sectors for the week, it's easier to say which ones were down. Healthcare, energy, and communication services. All of the other sectors ended up being positive when you just look at the 5 trading days. When you go back to the beginning of the year, we have communication, tech, and discretionary are positive. These have been the stronger areas. All of the rest of the sectors continue to be down year to date. Going back to the all-time high, energy is still in first place, with tech and industrials and healthcare, as well as staples, being slightly positive. All of the other sectors are negative, going back to that all-time high, with real estate doing about the worst. Looking at sentiment, we're starting to get extreme fear right now, and we're dropping below 25. So when we look at this on a historical chart, we came down to a lower level than this and then bounced up off of that. That's when we saw the little bounce in the market. But now it's starting to come back down. When it gets below 25, we start looking to use this as a contrary indicator. Here's the active asset managers. They're starting to get extreme negative now. These, even though they're professional money managers, they're human beings and they act with emotions. And we use this as a contrary indicator as well when they start to get extreme negative. So we have a reading of 24.82. We're getting down into that area. Just for example, when we hit the low in October 2022, we were even below 20. So this still could drop a little bit further. So this is on our watch list of potential contrarian indicators. We did see fear increase. The line chart ended up ticking down just a little bit for the week, but it's still above 20. The bar chart also is shooting up above 20, but we closed off of the high. This is just showing that fear is increasing. The Ulcer Index is also above its moving average and going up. We're seeing pretty much that same thing on the daily chart. The RIDEX bear bull ratio, this is, folks, starting to get a little more nervous about things, but this is only as of Thursday's close. When this really starts to spike up, that means folks are getting more bearish. And when we get extreme readings, especially negative ones, a lot of times that can mark a bottom in the market, but it doesn't look like we're there yet. We also had the latest reading from the American Association of Individual Investors. Again, that's you and me. So we're clumped into this as well, but they tend to react. I say we tend to react to what's already happened, and then we're pretty much late to the party sometimes. We're seeing their sentiment on the market start to decline, but not giving an extreme reading. But this is still giving us some hope. When you compare cash as measured by the 1 to 3 month T-bill, and then compare it to the tech sector, you have to kind of think of this a little backwards. When this black line is going down, that means tech is doing really well. We ran into some problems in 2022. Now we've been dropping back down. Now the market, since the end of July, has been showing some weakness. So this has been chopping a little bit higher, but it's not breaking above the Ichimoku cloud, at least yet. Keeping an eye on the economy, we did get the first reading of GDP this past week. So now the GDP Now estimate comes out with a brand new one. They're coming in a little bit over 2%. When you look at the top and bottom consensus range, we're at about 1 3/4% to the upside, where we're actually down about 0.5%. And this changes every week. Here's a bar chart where now this is the report that we just saw that came in up over 5%. So this is still pretty, I don't know, positive or exuberant, whatever you want to call it, because the GDP came in at 4.9%. Now we're starting to bring the fourth quarter of 2023 into the mix. But this is kind of positive because when we look at the spread between risky and not as risky bonds, this would really be spiking up if we were running into a lot of trouble. Yeah, it's going up, and you can make a case for that, but we're not spiking like we did during serious downtrends before. Having the latest reading from the Chicago National Financial Conditions Index, we're still declining here. It's when we get nervous is when we go back above the black line, and we're actually declining. And then these next few charts have not been updated. This is as of the end of July, showing how the banks are tightening their standards. And then this wasn't updated since October 6th, where this is the real-time SOM rule recession indicator. When we get really nervous, oops, I have to go back. When we get really nervous is when we go up to the red line and we're just barely above the black line. The same thing is true with the smooth recession probabilities, where we're down pretty much on top of the black line, not even close to the red line. So further out and longer term, we're still hanging in there. But these are government charts, and they can be very late in getting these things updated. So yeah, it can give us a really good answer of what we should have done 3 months ago. It's not, that's why we use these with a little suspicion. Then looking at the Brave Butters Kelly Index, this was updated the first part of October, where this is going up. It'll be interesting. We should get another reading when I do the weekly video next week to see if this is starting to come down or if it's continuing to go up. And that's producing a little bit of a concern. We're also keeping an eye on inflation. We just had PCE come out on Friday. A week ago, we had CPI come out. And this is just how the inflation numbers are adjusting as these reports come out. The Fed watch. We have a 99.9% chance that when the Fed meets and makes their announcement on November 1st that they're going to leave rates the same. This is 5.25 to 5.5, and that's where we're at right now. There's a 0.1% that we actually might lower interest rates, and this is showing how it's changed over time. The dark blue area is where we're at now. Then we have a day ago, a week ago, a month ago, and we pretty much have locked into this almost certainty that the Fed won't raise interest rates, but the market's going to be paying attention to every syllable that Jerome Powell says in his press conference. Here's the Fed balance sheet, which is continuing to go down the way they said it should. This is looking at it on a year-over-year basis where the assets are continuing to fall off. Then getting into our charts, we're dropping below the moving average based on price. When we look at the advanced decline line, we're showing more weakness based on volume. We're really seeing a lot of weakness on the daily charts too. We're seeing an expansion of the new lows and really hardly any new highs being generated. So our 4-week moving average and our 10-week moving average continue to decline. That's negative. We're dropping below zero with our advanced decline ratio, both the blue line and the red line. That is negative. Accumulation distribution, this tries to measure what the smart money is doing. Well, right now it looks like they're selling because we are below a declining moving average. Our trend, we're just a little bit above 20 and we're trying to turn back up, but we have not crossed over the moving average at least yet. So we're still in a trending environment, which for right now still looks to be weakening, but it's a negative trend because we have the red line on top and advancing where the green line is going down. Looking at the Arun, we're still positive here, and it's been going really crazy on the daily charts. We're still above zero, so that means we're positive. What this tries to do, the green line tries to measure buyers, and they're decreasing. The red line measures sellers, and they're decreasing as well. The difference between the two is how the oscillator itself is calculated. We're pretty extreme negative right now on the daily chart. The mass index on the weekly chart, we're not generating a signal right now. I'll go over that again when I show you the daily chart. Looking at our daily chart here, where we dropped well below the 200-day simple moving average, and right now it looks like we're in free fall. And we're dropping below the midpoint of this trend channel going back to 2009. So now we're taking on more negativity longer term. We're coming down to what potentially could be a pivot point here. If you think these are not important, the high that we set in July, we hit this level and that was the top right there. So we don't know this time. Why is this going crazy? We don't know this time if we hit this, are we going to be able to bounce up off of that? That's at about the 40, I have to look over here, 40, 50 level. If you want to be keeping an eye on that, that could be significant support. But longer term, the red line is still going up, but now we're starting to drop below the 50-week moving average. We're also dropping below the moving averages here with our long-term trend, and the blue line is rolling over, but it's still positive. The McClellan oscillator starting to get extreme negative. Well, it's the summation index below zero and declining, both based on price and volume. The Swenlin trading oscillator, which is actually turning more positive. We've seen it go up 2 days, Thursday and Friday. It's turning back up on the daily charts, but on the weekly chart here, we're declining based on price and volume. And the bullish percent index, we're also dropping below 30 on the daily chart. We came down to this other level and then went back above 30, and that's usually a pretty good buy signal. Well, it didn't last very long. Now we're dropping down, and we don't know if this is bottomed out yet, or if this is finally bottomed, and then we're going to turn and go back above 30. That would produce a pretty healthy buy signal. The PMO, which measures momentum, we're going down with the indicator itself. We're below zero based on price and volume. In our PMO studies, where we're declining with the PMOs that are rising, we're also declining with the buy signals, and we're starting to get extreme negative with the percent of PMOs that are above zero. The Bollinger Bands, we're starting to get extreme negative. We're not extreme on the daily chart, where this is a very rare signal indeed. Most of the time, in fact, like 97% of the time, price always stays inside of the Bollinger Bands, either the upper one or the lower one. Well, on the weekly chart, we've now closed below it, and we don't stay there for very long before either the Bollinger Band itself catches up or we see some kind of a bounce out of this. All of our oscillators on the weekly charts confirm what we're seeing on the daily charts. All of them are now pointed down and looking negative. We're seeing the same things on the daily charts. The Chaikin money flow, another smart money indicator that we use, is looking more negative. That's not a good sign. The Chaikin oscillator starting to get extreme negative, where we're just barely extreme on the daily chart. The force index is below zero and declining. That's also negative. The money flow is below 50 and declining. That's negative. Rate of change going back 1 week, we were down just a little bit, so that registers the decline that we saw. But going back 50 weeks or almost a year, we are seeing this continue to go down, but we're still above the zero level, which is the midpoint. The RSI based on 14 weeks is below 50 and declining. That's negative. The weekly special K chart is negative, and the daily chart is finally looking more negative now too. I'll show you that. The Stochk RSI is extreme negative and oversold. The Williams percent R is also extreme negative and oversold. The ultimate oscillator, we're seeing pretty much the same thing on the daily chart. We're just barely getting into an extreme negative reading, and you notice we don't get very many of these. The vortex is negative with the red line on top and advancing as the green line is declining. The Copic curve is pretty much negative right now. And looking at our longer term support levels, we're breaking below this 40-week moving average. That's not a good thing. The next real level of support could be the 200-week moving average, and that's ultra long term, a 200-week moving average. And we might come down to this 38.2% retracement level, but that would be a real big decline based on where we're at right now. But who knows? Anything can happen. Our different charts, the Heikin Ashi on the weekly chart is continuing to be negative. The Kegi is negative with the red line pointing down. The Renko chart is negative with red boxes, and the 3-line break is also negative. Looking at the ease of movement, I look at the bottom area where we're below zero and declining. That's more negative. And we had a new zero drawn in earlier in the week. We had a signal drawn on the daily point and figure chart, which was a double bottom breakdown. That was on the 26th of September. Well, we had another signal, a double bottom breakdown here on the weekly chart, was generated a day before that on the 25th of September. Our different trading systems, the Elder Impulse system is negative with red bars. The Parabolic SAR is negative with the dots on top. The PPO studies were declining in the long term. We've gone negative in the intermediate term, and we're also negative in the short term. Here's some daily charts. And if you've watched the daily video, this will just be a repeat of what you've already seen. I want to really give anybody who's going to take the time to watch my videos, I want to give you good, useful information. We look at the daily chart, end of day of growth versus value. And even with the down days that we've been seeing, this has been holding up rather well. And this can be taken as positive, where we're still in a longer term uptrend. We want growth to outperform value if you want to buy low and sell high. You get into value stocks when you're looking at getting dividends or just getting into a safer company. But right now, this is hanging in there. Also, this is another point of concern. Discretionary, as I talked about near the beginning, they're one of the stronger areas in 2023. Well, on this equal weight ETF discretionary that we're looking at, we have now seen a death cross here, and we've been declining. The staples are also weak, and we've been falling with the overall ratio, even though we ticked up a little bit on Friday, and we're still in a longer-term uptrend. The 5-period equity put call ratio, which was looking like it was starting to decline, now it's starting to go back up. That's negative. And our longer-term equity put call ratio, based on 253 periods, this is continuing to go up, which is longer-term negative. Here's the mass index. We're not getting a signal on the weekly chart. This is the daily chart, where we came above the red dashed line. That's point number one. But then we have to go above the blue line and then start to turn down. And if we do that and then cross below the red dashed line, whatever the market's doing at that point, this indicator tries to say, okay, now the market's going to do the opposite. We had another one of these signals generated at the end of August that really never led to anything. And since we never got up to the blue line, if this continues to fall, that would not be a valid signal. But we are dropping further below the 200-day simple moving average. This is a new chart, and I draw these lines on here, so these percentages may not be exact. The first time I used this was a number of months ago when we were measuring from the all-time high to the October 2022 low, and then we started bouncing back up, and what looked like we were getting above that 20% level. Well, here's the high that we set in July, and now since we've been going down as of Friday's close, we're down over 11%. From that intraday, at least not all-time high, but swing high, I guess you could say. Now, the reason they're saying 10 point something in the other part where I mentioned, I'm counting intraday, where they're going from a closing value here and then dropping things lower from there. Our short-term fib chart, we're starting to break support. We're down below the 100% retracement level on this fib chart. There's another 100% retracement level, and we're now just a little bit below that. And then we're dropping below the 50% retracement level on a longer-term fib chart. And then when we look at some fib lines that are over top of each other, we're dropped below this 4,208 level, and we're continuing to fall. We're wondering if we're going to come all the way down to the 40-20 level. We're also dropping below this quadrant level. This has been giving us fairly good support. Before that, it was acting as resistance. Now we're starting to break below that. This is a chart that I talk about, but my goodness. This was a chart, and this came from, what is it, Game of Trades or something, where I originally got the idea for this chart, and then I ended up recreating it myself, where we drew a line from the June 2022 low to the October 2022 low, and then have a trend line down here. And then up on the top, there's a parallel line going from the all-time high, and then it's supposed to be parallel to the blue line. Well, when we were going up last spring, we bumped into this a few times, and it was actually acting as resistance, but then we were able to break above it, and so I didn't show this chart for a long time. Now, as we're starting to descend here, we're getting closer to this red line, so we just want to keep an eye on this. We're well below the 200-day simple moving averages, and all the other moving averages in our tree continue to go down. This is another kind of significant thing. An anchored moving average going back to the all-time high. We've been above it for pretty much since we broke above it back in March or April. Now we're starting to come back down below it. If we continue to fall, we'll be watching these other anchored moving averages going back to the COVID low. We're also breaking below different trend lines. We were starting to come back down. This green line looked like it was providing support. Then we fell through that. Then I drew another textbook defined trend line here going from this low to these lows. We've also closed down below that. So technically, we're looking pretty stinking ugly right now. Here's the daily chart of the special K, where it was just trailing along the red line. Now it's starting to break lower. We don't get a lot of signals with this indicator, so this turning negative could be significant. Now, we turned positive and then fell back and then turned positive again, That could always happen here, but we just want to know that this is on the table right now. This is kind of our last period of hope as far as support, unless the market uses something else as support. This is the NASDAQ 100, where we've just been breaking through all kinds of support, but we're still above the 200-day simple moving average. If we fall down here, this is what I'm going to be watching. And if we bounce up off of that, that could change everything. If we come down here and fall below it, that could keep things the way they've been going right now. Just something to be aware of. When we look at the NASDAQ 100, we're falling below the 61.8% retracement level and now possibly headed down to the 50% retracement level. Then looking at the NASDAQ, we're already below the 200-day moving average. That's negative. And then with the NASDAQ, we're coming down to this 38.2% retracement level, and that's a pretty significant decline. We're also keeping an eye on the FANG index, where we were maintaining price above these previous lows. Now we're starting to break below that. And then our arithmetic scale on a weekly chart going back to 2009, we're falling further below the red line, which is a trend line. We're also keeping an eye on the financial sector. It just gave us a death cross, and we're coming right down to this support level. This had been resistance, and then we broke above it. So now it's acted as support on more than one occasion. Yeah, we came down and dropped a little bit below it, but we were able to bounce up out of that. Right now, we're right on the line. Some broad market measures. This is a seasonality where we focus here on October. Believe it or not, we're still up 2% for the month of October, and we tend to be up more than down 60% of the time. And then you can see going forward for November and December where we tend to see positive seasonality. Here's just a blanket chart of the S&P mid caps and small caps. We're seeing how mid caps are breaking down as well as small caps, and of course the S&P. They're all not looking very healthy right now. The Dow is still in an uptrend, but we're falling below the moving averages, and the blue line is starting to roll over. The NASDAQ, we're coming right down to this 50-week moving average here. Maybe we'll find some support up off of that. And the NASDAQ 100, we still have a ways to go to come down to its 50-week moving average. And that could produce some real pain, but if we bounce up off of that, that could be pretty significant. The mid caps are starting to give us a death cross now. We've already seen that on the daily charts. Now we're starting to see this here on the weekly chart. The small caps have already given us a death cross where they've been already a death cross on the daily chart. The NYSE also showing some weakness, beginning to roll over, but hasn't quite crossed yet. All stocks rolling over with the blue line, but still in an uptrend, but falling below both moving averages. The 30 biggest software companies, we're crossing over. This is now a death cross here, where the 13 is now moving below the 50-week moving average. The FANG index, this was actually up in Friday's session on the back of some earnings reports. So we're hanging in there okay with this, but we're still below this blue moving average. ARC, it's kind of coming back and having trouble again. It's dropping below the moving averages. Hasn't done a death cross at least yet, but if we stay below this, that's going to happen pretty soon. The banks also under a lot of pressure. We're starting to get extreme negative with the weekly RSI. We're also showing that weekly momentum is now turned negative. And deposits are going out. It's kind of hard to see here. You have to look at the number over here on the top where we actually saw more money going out than in. And then here's just a blank chart of Dow theory. Traditional Dow theory just looks at the Dow and the transports. I also include utilities where they're starting to chop more or less sideways. Unfortunately, we're seeing a lot of weakness in the transports right now, and that is not good for the market. We need the transports to really perform well, where the Dow is also starting to show some breakdown here. The CRB index continues to be in an uptrend, and that could be inflationary for stocks. Oil dropped a little bit this past week and closed at 85.54. Copper is now in a downtrend, both on the daily chart and now on the weekly chart. Actually, not quite. If you look at the numbers over here, we're still just a little bit above the red line. The dollar continues to do quite well, and it was up on the week and is in more of an uptrend, both on the daily chart and here on the weekly chart. Gold, it started to really break down, and then we had these geopolitical things start to happen, and now gold's starting to go back up, but it's far from breaking out right now. And silver also just generated a recent death cross here, but has been seeing a bit of a bounce. Looking at bonds, the total bond ETF, this is bonds based on price. They are in a downtrend. but stocks still continue to outperform bonds when we look at a monthly chart. This is still normal now. We take the 1 month yield and subtract the 3 month yield. We should always get a negative result, and that's what we're getting right now. Here's the a daily chart of all the different maturities showing how interest rates have really been going up overall. Here's a weekly chart looking internationally where we have the green now on top. That's the US. The black is the UK. We have the blue, which is Germany, and even Japanese rates have been starting to go back up. Some relative studies. Here's intermarket analysis where we have oil that's still in the lead, followed by gold now, and now stocks, which had been in first place for quite a while, now they're in third place. And then we have the dollar, where bonds based on price continue to be negative, and they dropped negative ever since August. Here's a longer term look going back to the beginning of 2022, where oil's in the lead, followed by the dollar, and then gold, where stocks and bonds continue to be underwater there. Here's a ratio of the NASDAQ 100 to the S&P. This is still holding up fairly well. Both the NASDAQ 100 and the S&P been getting hit lately, but so far the NASDAQ 100 is still doing better. The S&P 100 continues to outperform the S&P 500. Growth is still continuing to outperform value, even though it has been turning down. Gold is really starting to shoot up compared to the S&P, but it's still in a longer-term downtrend. However, the longer we stay above the red line, eventually we may see a golden cross. And gold is really having a difficult time because the dollar's been pretty strong lately. So even though this is going back up, it still hasn't been able to break above these trend lines. Bonds are showing a little bit of an improvement here, but longer term, they continue to underperform stocks. Low volatility, and I brought this out a week ago, where we could be making a double bottom here. That's not necessarily positive for the market. Low volatility stocks are those that tend to do better when the market's running into problems. And the fact that these are starting to go back up could be negative. Discretionary is still continuing to outperform staples, even though we've been seeing some weakness in discretionary. And then we look at the energy to tech ratio, where energy fell back. The energy is still underperforming tech, but we did see energy really starting to outperform here recently. Our longer term studies. This is the long-term seasonality and setups that I talk about, where a year ago now in October 2022, that's when we hit a bottom. And this is still on the books, even though we've been seeing some weakness with this reading. We also have the ZWAG NYSE breadth thrust, which generated a signal in March. That's when it gets to a real low level. And then in a very fast period of time, it gets up to a high level. Even though this has been showing some weakness, from my understanding, this is still on the books. This is a Horchak method is now continuing to show some weakness. For most of 2023, it's been giving us a solid buy signal. That's when the number's all the way at the top. Now that we've been going down, it's actually dropped. It's not necessarily negative right now, but it is picking up the weakness that we've been seeing. The problem with this chart is there's a 1-day lag on this. So this is Thursday's close. Here's a longer term trend line going back to the 87 crash, where we're starting to fall even more below this longer term trend line. Then looking, that's the same chart, but only going back to the beginning of 2018, we're falling further below this longer term resistance level. And the same thing is happening with the NASDAQ 100, where we're falling more below the trend line. We look at a ratio of the NASDAQ 100 to the Dow. This is not really declining the way you might think it would. So for right now, it's been hanging in there. And then this is the QQQs, which is the NASDAQ 100. And then we look at a ratio of that with the Russell 2000. And these are ETFs, where this is never really did come back up to this blue line. Now, if you look at just the indexes, which I don't have access to, they've screwed around with those a little bit. We came up to this blue line and now have started to go back down, where we're not seeing that with the ETFs, but they're calculated a little bit differently. This is another one that I refer to quite often. This is the new highs, new lows on a cumulative basis for the NASDAQ. And going back to the end of 2021, we've been seeing this continue to decline. That's longer term negative, but is it really having an impact? When we look at the raw score from day to day, we're well below zero and declining because we've been negative. We're also keeping an eye on the 3-month yield. Now, we don't know if that's going to become relevant or not. We're just watching this because this is what happened back in 2007. It topped out, started to go down, and that was the great financial crisis. Well, we're continuing to pretty much go up. We haven't really rolled over yet with this. Tom Bowley comes out with some research. He publishes this through earningsbeats.com. This is a free email that he sends out. He's also connected with stockcharts.com, where now we're coming into the more positive time of October. Of course, that's the weekend here. We just have the 30th and 31st left to go, where they tend to be up historically. So this is just for a Monday session. What are we looking at? We're dealing with earnings season. The UAW strike is still happening, but there's some progress made in that with Ford. And then we're looking at Israel, which is dealing with Hamas and possibly Hezbollah and possibly Iran. And then there was a Hamas meeting in Moscow this past week. That could drag Russia into this whole thing. Russia and Iran have been teaming up. We've got NATO over here with the U.S. I mean, it could really get crazy. And we've got U.S. supporting Ukraine. Russia's also in a war against Ukraine. It could develop into a mess. Our technicals on the daily charts were negative and we're breaking below long-term support. We're wondering if some kind of a base is forming. We're not really seeing much of that right now. We're kind of watching to see if something like that will happen. We won't get any economic reports on Monday, and then we're keeping an eye on all the different geopolitical events. The new one here is the bombing that has taken place in Syria that was done by the U.S. on, let's see if I can get it right this time, Iran-backed terrorist groups. Here is the economic calendar. I've tried to highlight the things. Any one of these can be important. Well, not any one of them, but a lot of them can be more important. But the big ones tend to be ISM manufacturing. That's going to be on Wednesday. And then at the end, near the end of the day, we're going to get the FOMC with their announcement and press conference. And then on Friday, we're going to get the big jobs report. And then we're also going to get ISM non-manufacturing. So we're getting a lot of pretty important information kind of all at the same time. For Monday, October 30th, we are positive when we look at the Stock Traders Almanac statistics. We're positive across the board with all three indexes. We will be on the 21st trading day of the month, where we do tend to see during our pre-election year. That's the green dashed line. This is going up. Even historically, we see some positive signs in here. So we have seasonality on our side. We're just not seeing any confirmation in the charts. And we're wondering, are we going to see that little bump up here when we look at a pre-election year for the S&P? Also, are we going to start to see some kind of a bump based on the Carson research? And then some more Stock Traders Almanac charts where the NASDAQ, sometimes it bumps up in the latter part of October. The S&P, also the green line, tends to bump up in the latter part of October. Here's the seasonality chart that I've been showing for a while. I just shifted this box a little bit forward to try to get where we're at. Are we getting close to a seasonal low here? And are we going to start to bounce up from here? We don't know that for sure, but we do have seasonality on our side. And then this is a relatively new chart. This is going back from 1950 up to 2022, where we're right about in this area. Are we going to be able to bounce up off of this and then see things more positive going into the end of the year? We do tend to be up more than down for the month of October when we go back to 1950 and just look at pre-election years, but not very much. So our scenarios for Monday, we're going with the down one right now because our technicals are negative and we're continuing to break longer term support. There's nothing to justify going up right now unless you're an ultimate risk taker. We're really not seeing any confirmation of that, and we're not going with any sideways positioning right now because we are in a trend both with our short-term ADX chart and our intermediate-term ADX chart. So the warning signs, and this list is getting longer. We're seeing the daily special K chart crossing over negative. The weekly chart is also negative. Our longer-term equity put-call ratio is going up. That's negative. The risk-on posture, it was up a bit on Friday, but overall it's been in a pretty significant decline. The 5-period put-call ratio that we look at is continuing to go up again. That's negative. On a momentum basis, our S&P 500 oscillators as well as the NASDAQ 100 PPO that we watch are negative. The bullish percent index for the BPI, for the S&P, there's one of my trip ups there. It's gone back below 30. The Vortex and the parabolic SAR charts on the daily charts are negative. And then we have a longer term study based on 50 periods, taking an exponential moving average of the new highs and new lows. That is negative. And the Russell, small cap and mid caps are now working off of death crosses. The financial sector, this is just after Friday's close. It's now generated a death cross. Here's some longer term warning signs that I usually don't go through in the daily videos. The longer term trend signals, they may be signaling that we're at a top. That's the weekly chart of the S&P and the NASDAQ 100, where we're coming up to that long-term trend line and still continuing to decline. The cumulative new highs and new lows for the NASDAQ are showing weakness. The 3-month yield is above where it was in 2007. We don't know if that's relevant or not. We're just keeping an eye on that. And then earnings season can be either positive or negative, like we saw this past week. Positive signs, and look at how short this list is. There's 2 points for the daily charts. The Pring bottom fisher is still generating a buy signal, but it's like, okay, it's almost laughable because the chart's clearly going down. And for this to generate a buy signal, we just really can't pay attention to it. And when you take a longer look at small and mid-cap growth, they continue to be positive, even though they've been chopping sideways and been under some recent pressure. Positive signs, the seasonality, as I've been showing in the charts, and historically, October can end up being positive, but it's where do we go from here? The long-term positive seasonality and setups, those are still in the background. Those longer-term NYSE charts that I was showing you, they're still longer-term positive. We do have seasonality on the positive side. The S&P is still above that downtrend channel upper line. That's the chart that I never showed, that I showed in this video. And then our conclusion for Monday's session, we are negative. It's a confirmed downtrend, and we're falling below longer-term support. In the short term, we're starting to become oversold, but we could still fall further from where we're at, or we might be able to bounce up out of that. The intermediate term, turning a bit more oversold, but really we're just dropping below support and still looking negative. And we're now negative in the long term because we're below the 200-day simple moving average. Thank you. I really hope you found this helpful. I hope you have a great weekend. Please feel free to check out the daily video. After this, I will be posting the intermarket analysis video as well as the deep dive video. Have a great weekend. I hope your team wins the World Series or your game, NFL game on Sunday, and I will talk to you in the next video.